Welcome to the deep dive. Today, we're tackling a topic that hits close to home for a lot of people: real estate.
Yeah, it's often someone's biggest asset, right?
Right.
But also potentially their biggest financial worry.
Exactly. We're zeroing in on that fear, the anxiety around the term housing bubble, especially when prices seem, well, totally disconnected from reality.
It's a really important conversation to have. It's easy to get swept up in headlines predicting doom or, conversely, endless growth.
Right.
But our goal here isn't prediction. It's about equipping you, the listener, with the tools, how to tell the difference between solid, fundamental investing and just, speculative mania.
That's the mission for this deep dive. We've got insights from investing principles, a bit of psychology of influence, some cautionary tales from big real estate blowups.
And crucially, practical strategies for building wealth over the long haul. Strategies that can weather these storms.
We want to help you filter out the noise. Think like an economist, like a long-term investor. Focus on the fundamentals, not the frenzy. Okay, so let's first unpack what drives speculation. Because really, the core dilemma is the same whether we're talking Bitcoin or a red-hot housing market.
Absolutely. When something goes parabolic, shoots straight up, everyone asks, is this the future? A genuine revolution?
Or is it just another bubble about to pop, taking fortunes with it? The sources use Bitcoin as a really good example of this exact tension.
Yeah, and what's interesting, often the answer is, well, it's kind of yes to both. And that's what trips people up.
How so?
Well, the underlying thing, the technology, like blockchain or maybe strong local job growth in a housing market, that part might be totally real,
Right.
genuinely valuable long term.
Okay, so there's real substance there.
There can be, yeah.
Yeah.
But then the speculation kicks in. It's like pouring gasoline on the fire, pushes the price way, way beyond that fundamental value.
Based on a story and narrative.
Exactly. And a narrative of, like, this time it's different, unlimited potential. And that means people buying in late, caught up in the hype, they're almost guaranteed to get hurt when reality bites back,
Yeah.
even if the core thing eventually succeeds.
So for real estate, that underlying technology might be solid local fundamentals. Maybe you can't build more homes easily, great jobs are coming in.
Right, real economic drivers.
But the price mania, that's driven by something much older, much more primal, really, human psychology. Specifically, this thing called the scarcity principle.
Oh yeah, this is a powerful one. It's baked into us. When we perceive something valuable, especially something essential like housing, is limited,
Our desire for it just skyrockets.
not just desire, our perceived value of it. It goes way up, often completely divorced from any rational calculation of what it's actually worth based on, say, rents or incomes.
The sources mentioned a classic psychology experiment that shows this really clearly, the cookie jar study.
Yeah, yes, Worchel's study. It's brilliant in its simplicity. Basically, people were asked to taste and rate a chocolate chip cookie. Standard stuff.
Okay.
But here's the twist. One group saw the cookie come from a jar with 10 cookies in it. Abundant supply.
Right.
The other group saw the exact same cookie come from a jar with only 2 cookies. Scarce supply.
And the results.
Stark. The cookie from the nearly empty jar, the scarce one, was rated as tasting better, more desirable, and people thought it cost more. Same exact cookie.
Wow. Just the perception of scarcity changed everything.
Completely. It tells you our brains are just wired to want the hard-to-get thing more, regardless of its actual quality.
And you map that onto housing, limited supply, whether it's zoning laws, geography, or just slow construction.
And bam, the perceived value of existing homes shoots up way past what local rents or incomes can justify. It creates this irrational exuberance.
Scarcity triggers FOMO, right? Fear of missing out.
Absolutely. And that immediately shifts the focus. People stop thinking about long-term investing, calculating cash flow, how the loan gets paid down over time.
And instead, they start chasing quick wins, speculating.
Exactly. They get, as the sources put it, incurably smitten with the speculative bug. They think they can time the market, pick the winners, make a fast buck.
This sounds like the house flipping craze we hear so much about. Buy low, fix quick, sell high, pocket 6 figures in a few months. Sounds amazing.
It sounds amazing. And sure, some people make money, but the sources are really clear on the dangers. First, it takes serious time and skill. You need to know renovations, manage contractors, understand the local market deeply.
It's not a passive investment.
Not at all. But the biggest risk. Flippers are incredibly vulnerable to market shifts. If you buy planning to sell in 6 months and prices drop just 5%,
Your profit margin could vanish.
or worse, you could lose money. instantly.
Whoa.
Because your holding period is so short, time is actually working against you.
Yeah.
Every day costs you money and increases risk.
Whereas the buy and hold investor, assuming they bought right.
Time is their friend. If the market dips, okay, fine. They keep collecting rent, keep paying down the mortgage principal, they can wait for the recovery.
So building resilient wealth means resisting that urge for the quick flip.
Pretty much. You have to step back from the excitement, embrace strategies where slow, steady progress, driven by fundamentals, works in your favor over time.
Okay, stepping back means getting rational about valuation. How do we know when prices are getting speculative? We need some benchmarks, right? Like in the stock market.
Exactly. The same core principles apply whether it's a stock or a rental property. It's about the income it generates. Rule number one in rational investing is pretty straightforward.
Which is?
You should be willing to pay a higher price for an asset if its earnings or dividends or rents are growing faster. Makes sense.
Yeah, more growth equals more value.
And the second part is you'll pay more if that faster growth is expected to last longer. Sustainable growth commands a premium.
And the common tool for comparing this is the PE ratio, price to earnings.
That's a classic one for stocks. It tells you how many dollars you're paying for each dollar of current annual earnings. A PE of 15 means you pay $15 for $1 of earnings.
It's a yardstick for comparing relative value.
It is. But here's where bubbles get dangerous. People stop focusing just on the earnings growth of the company or the rent growth of the property.
What do they focus on then?
They start betting that the multiple itself, that PE ratio or the price to rent ratio in housing, will just keep going up indefinitely.
Ah, so they're not just betting on the horse, they're betting the odds will keep getting shorter.
Perfect analogy.
Yeah.
And that introduces a huge risk, market revaluation. Even if you're totally right about the asset's performance, you can still lose badly if the market changes its mind about the multiple.
This sounds critical. Can you walk us through the example the sources use, the biodegradable bottling company?
Yeah, it illustrates the point well. Imagine an analyst researches this company, biodegradable bottling. They do great work, correctly figure out and grow earnings at a solid 25% per year for a long time.
Okay, strong fundamentals.
Definitely. Then the analyst looks around and sees other companies with similar growth are trading at, say, 40 times earnings, a PE of 40.
Right, that's the market standard for that type of growth stock at
Yeah.
that moment.
Exactly. But biodegradable bottling is only trading at 30 times earnings. So the analyst thinks, great, strong growth, cheaper than its peers, it should rise to that 40 PE. So they buy the stock.
Seems logical. Solid company, relatively undervalued compared to the market standard. What could go wrong?
The market changes its mind. A few months later, maybe interest rates rise, maybe sentiment shifts, whatever. The market decides that all growth stocks are too expensive.
So the acceptable multiple drops.
Right. Suddenly the market says, you know what? We're only willing to pay 20 times earnings for this kind of growth now. The standard PE for the whole sector falls from 40 down to 20.
Ouch.
Big ouch. Because even though our analyst was 100% right about biodegradable bottling's 25% earnings growth, the company's hitting its numbers perfectly, the stock price still falls.
Because the market just decided to pay less for every dollar of earnings across the board.
Precisely. The investor loses money not because the company failed, but because the market re-rated the entire category downwards, the multiple compressed.
And that's exactly what can happen in housing, right? We talk about price-to-rent ratios. If everyone's paying 25 times annual rent for houses.
Yeah, a price-to-rent multiple of 25.
And then suddenly the market decides, whoa, that's crazy. The long-term average is more like 15. Then even if rents stay totally flat,
your property's market value could plummet. In that example, going from a 25 multiple to a 15 multiple means a 40% drop in price, even with zero change in rental income.
that really shows how in a bubble you're fighting the market's mood swings, not just the property's performance.
You are, and we saw this play out catastrophically in the real world. With the Stuyvesant Town and Peter Cooper Village deal in New York City, a massive transaction.
Remind us of the details. This was huge, right? $5.4 billion, and it went bust.
Textbook case of overpaying based on pure speculation about future income. Tishman Speyer and BlackRock bought this huge apartment complex in 2006, right before the crash.
Bad timing.
Terrible timing. But the price itself was based on what the sources called highly speculative assumptions. They weren't paying for the rent money coming in then.
What were they paying for?
They were paying for the hope of jacking up rents dramatically in the future. See, most of the units were rent stabilized, protected by law. Their whole plan depended on kicking tenants out or getting them to leave really fast.
So they could deregulate the apartments and charge much higher market rents.
Exactly. They needed incredibly high turnover. Their projections were wild. They aimed to triple the property's net operating income, the NOI, in just 5 years, reaching over $300 million by 2011.
Triple it. How many apartments needed to turn over for that?
Their model needed an average of 612 apartments deregulated every single year. It's a huge number, requiring them to basically churn tenants constantly and navigate New York's complex rent laws perfectly.
So it wasn't just a bet on market demand. It was a bet on operational and legal execution at an extreme level.
Totally. It was financial engineering on a grand scale. And then, of
Yeah.
course, the financial crisis hit.
Which stopped the music.
Completely. The economy slowed, pushing back against big rent hikes. The political climate got tougher for deregulation. The aggressive turnover they needed just didn't happen.
And the debt.
They couldn't make the payments. The income wasn't materializing as projected. They defaulted on the massive loans by early 2009. The price they paid was untethered from the reality of the property's actual cash flow at the time. It was pure speculation on an engineered future. Other bidders even called the price really silly beforehand.
A very expensive lesson in the dangers of speculative assumptions.
So if that speculative path is so risky, relying on future price jumps or, complex financial engineering,
What's the rational alternative? Where should investors focus?
the sources point towards something much less glamorous, honestly, almost boring, but incredibly powerful. Equity buildup through amortization.
Amortization, that's just
Yeah.
the process of paying down the loan principal over time.
Right. Exactly. It's the simple, undeniable math of debt reduction. And it's the bedrock of sound long-term real estate investing. It builds wealth regardless of market swings. It's the anti-speculation anchor.
Okay, break down the math for us. Why is this so powerful even if we assume, say, zero appreciation in the property's value?
Let's use a simple conservative example. You buy a property for $100,000. You put $10,000 down, so you borrow $90,000.
Standard 10% down.
Right. Now, fast forward 30 years. You've made all your mortgage payments. The loan is paid off. You own the property free and clear.
Okay.
Now, let's make a really pessimistic assumption. Let's say the property's market value hasn't increased at all in 30 years. It's still worth exactly $100,000.
Which is pretty unlikely, but okay, for the sake of argument.
Highly unlikely, yeah. But even in that scenario, your initial $10,000 cash investment has turned into $100,000 of equity. You've multiplied your money tenfold.
Just from paying off the loan. Or rather, having the tenant pay off the loan through rent.
Precisely. The sources calculate this gain just from amortization, with zero appreciation, works out to roughly an 8% annualized return on your original cash investment.
An 8% return, basically guaranteed by the loan schedule, paid for by someone else.
That's the power. It's a built-in wealth creation engine that operates completely independently of market sentiment or Zillow estimates. It's your safety net against volatility. The flipper has nothing like this.
This leads naturally into using leverage, using debt smartly, because you need leverage to scale, right? But owing, say, $1 million on several rental properties can sound terrifying.
It can, absolutely. But the key difference, the thing that lets you sleep at night, is knowing how that debt gets repaid.
Yeah.
Rational debt versus speculative debt.
And in rental investing.
The tenants repay the debt. That's the fundamental reality. And this is big if you bought the property right and financed it wisely.
Which means doing your homework before you buy.
Yeah.
What are the absolute must-know numbers?
2 things, non-negotiable. You must know the verifiable market rent for that specific property in that specific area. Not aspirational rent, actual market rent.
Okay, verifiable income. What's number 2?
Total operating expenses, and I mean total, not just the mortgage payment principal, interest, taxes, insurance, PITI. You also have to budget realistically for vacancies, for big ticket repairs down the road, new roof, new HVAC, that's capital expenditures or CapEx, and routine maintenance.
You need to know all that before you even make an offer.
Absolutely. You need to be confident that the realistic market rent will comfortably cover all those costs, including your debt service. That's positive cash flow, or at least break even. That's defensive investing. That's the foundation.
Got it. Now, sometimes good deals, especially distressed properties, require moving fast, often with cash. Traditional mortgages can be slow. The sources mention using HELOCs here.
Yes, home equity lines of credit. This can be a very smart way to use leverage strategically. You're borrowing against the equity you've already built up in your own home, your primary residence.
And why is that advantageous?
Because the bank's lien is on your house, a known quantity to them. They're generally less concerned about the condition of the new property you're buying with the HELOC funds.
Ah, so you can use it to snap up a fixer-upper that needs a ton of work, something a regular mortgage lender might balk at because it's not immediately habitable.
Exactly.
Yeah.
It gives you speed and flexibility. You can essentially act like a cash buyer, fund the purchase and the rehab, get the property stabilized and rented out. It lets disciplined investors grab opportunities that others can't. Hashtag FUI. Mitigating risk through disciplined practice and due diligence. So, if the smart investor isn't just betting on the market going up, how do they actually create significant value relatively quickly? They don't speculate, they manufacture value.
Manufacture value. Okay, how?
Through disciplined execution. The classic model for this is the BRRR strategy.
Right. BRRRR. Let's spell that out for everyone.
Sure, it's buy, rehab, rent, refinance, repeat. Buy, rehab, rent, refinance, repeat. Okay? And the key part for getting your capital back out is the refinance step. That's the exit, yes. It's how you pull your initial investment back out to go do it again, the repeat. It feels a bit like a flip in that you're getting cash out based on a new value, but the focus is totally different.
How so? A flip relies on selling into a rising market, right?
Austin, yes.
Yes.
Or just selling quickly. BRRRR relies on the value you forced through the rehab. You're betting on your own work and smart improvements, not market momentum.
So you have to be really smart about the rehab part, making improvements that actually add more value than they cost.
You have to be surgical. The whole strategy hinges on the after-repair value, the ARV, being significantly higher than your total cost, that's purchase price plus all rehab costs.
There's a specific math hurdle you need to clear.
Absolutely. The sources give a good rule of thumb. Let's say your total all-in cost purchase and rehab is $70,000. To make BRRR work properly, that property needs to appraise for at least $100,000 after the rehab is done.
Why $100,000 specifically on a $70,000 cost?
Because when you go to refinance, the bank will typically only lend you a percentage of that new appraised value, usually 70% to 80% loan to value, or LTV.
Ah, okay.
So if the property appraises for $100,000 and the bank lends you 70% LTV, that's $70,000 cash back to you from the refinance. You've recovered your entire initial investment.
And if it only appraises for, say, $90,000?
Then 70% LTV gets you back only $63,000. You've left $7,000 of your own cash stuck in the deal, which isn't terrible, but it slows down the repeat part.
So this forces discipline. You have to focus on renovations that appraisers value highly, like adding square footage, bedrooms, bathrooms, not just fancy finishes that cost a lot, but don't move the appraisal much.
Exactly. It forces you to think like an appraiser and add tangible, recognized value. It's the opposite of just hoping the market bails you out. You control the value creation.
Okay, that's manufacturing value. What about acquiring the property in the first place? Discipline applies to negotiation, too, especially in competitive markets where sellers think they hold all the cards.
Definitely. The sources mention a specific psychological tactic here, based on the principle of reciprocity. It's called the rejection then retreat technique.
Rejection, then retreat. Sounds interesting. How does it work?
It's pretty clever. The idea is you start by making a larger request, something you actually expect the other person to reject.
Okay, ask for more than you want.
Right. Then, once they've rejected that initial large request, you immediately retreat to a smaller request, which is actually the thing you wanted all along.
And the psychology.
Because you made a concession by retreating from your big request, the other person feels a subconscious obligation, due to reciprocity, to also make a concession. They feel compelled to agree to your smaller second request.
How would a buyer use that in real estate?
Well, you might start with a really low-ball offer, your big, likely to be rejected request. That sets a low anchor point for the negotiation.
Okay, seller rejects it. Then what?
Then you retreat to a slightly higher price, maybe one that's still below asking but seems reasonable compared to the initial lowball. Or you could retreat by asking for significant seller concessions, help with closing costs, a credit for repairs, maybe even seller financing terms.
So the seller feels like they won't by getting you off the super low price, making them more willing to give in on the other terms you actually cared more about.
That's the idea. It frames the negotiation in your favor. Setting that initial anchor is key.
Smart. But whether you're doing BRRR or negotiating hard, none of it matters if the property itself has hidden disasters. Which brings us to due diligence.
Absolutely critical. This is your final layer of risk protection, especially in potentially frothy markets. For buyers, the inspection contingency is non-negotiable. You need licensed professionals to go through that property top to bottom.
Looking for what? Big structural issues. Deferred maintenance.
Everything. Roof, Foundation, plumbing, electrical, HVAC. You need to verify the condition matches the price and your plans. Reviewing seller disclosure statements is also vital. Never, ever skip your inspections just because it's a hot market and you feel pressured. That's how you buy a money pit.
And from the seller side, if an inspection does turn up a major problem, what's the smart way to handle it without scaring the buyer off?
Transparency is key, surprisingly. If the inspection finds a genuine major issue like the roof really is failing or there's a foundation crack, the sources strongly advise offering the buyer a credit towards a professional repair.
Rather than trying to fix it yourself quickly and cheaply.
Definitely don't do that for major structural things. Imagine you're the buyer. You see an inspection report highlighting a leaky roof, and then the seller says, "Oh, don't worry, I patched it myself last weekend."
Yeah, that doesn't inspire confidence.
It strikes fear into the heart of any buyer, as the source puts it. They'll assume the worst, that it wasn't done right. Offer a credit so they can hire a licensed pro they trust. Let the pros handle the big stuff. Sellers should stick to minor cosmetic fixes themselves. #tag outro.
So we started this deep dive talking about the anxiety around housing bubbles, but I think digging into the sources really clarifies that line between, panic-driven speculation and rational, disciplined investing.
Yeah, it really comes down to consciously fighting those psychological pulls, the FOMO from scarcity, the lure of the quick buck. You have to anchor yourself in the fundamentals.
Fundamentals like what? Let's recap the core principles.
It's about disciplined valuation first off, making sure the numbers work, that the rent really covers the total costs, using debt wisely, where repayment is covered by the tenant, not just hopes of appreciation.
And manufacturing value through smart strategies like BRRRR rather than just betting on the market. Rigorous due diligence.
Exactly. If you get those fundamentals right, you're investing. If you ignore them and just chase prices, you're speculating. And that's where people get wiped out in downturns. Clarity on that difference protects your wealth.
And if there's one single concept, one core truth from all this analysis that listeners should really latch onto for long-term security, what would it be?
It's got to be the power of amortization. That's steady, almost boring process of paying down the loan principal.
Like equity buildup.
That equity buildup happens month after month, year after year, paid for by your tenant. And here's the most powerful part the sources highlight. That process continues, building your wealth reliably.
Even if
the market value of your property stays completely flat for the next 30 years. That 8% or so return from just paying down the debt is your bedrock.
Wow.
It's the ultimate guardrail against the craziness of market bubbles and speculation. Stick to that fundamental truth, ensure your cash flow works, and your investment is built on solid ground no matter what the headlines scream.
That is a powerful foundation indeed, and a great place to leave it for this deep dive. Thanks for joining us.